Vetri Subramaniam, the Chief Investment Officer at UTI AMC, is now here with us live on the show. Good morning. What a week it's turned out to be. A week where a lot of the chatter and conversation has been, okay, India's outperformed, there was decoupling, but can this outperformance continue because China is coming back? We might see higher allocations. It's trying to make a change, as far as reviving its property market goes. Look at the way, we've seen the stocks also move in Shanghai. You give us a sense of what's happening. Are we seeing higher allocations now to China? Because that can affect India's outperformance.
Sure. So, I think it's important to keep in mind that India has been among the global markets who have strongly outperformed this year. And I think that is clearly a reflection of the fact that, the way investors have perceived both India's stability from a geopolitical context, as well as the stability that they have perceived in the sense that our macroeconomic parameters, no doubt, everybody's macroeconomic parameters have been stressed over the last few years, but relatively speaking, our numbers are still in far better shape than other parts of the world. So when you take those two into account and you look at the longer term trajectory in India, I would, think that one of the reasons India has held up so well this year in a relative context, right? The absolute returns are nothing to write home about. That's more to do with perhaps starting valuations. But the outperformance had to do with the fact that the initial conditions in terms of macro, geopolitics far superior, and the potential for longer term growth rates looking far better. Now, that's a great set of circumstances or, conditions to have working in your favor when the whole world is in turmoil. Now, if you suddenly start to change your perspective towards maybe something is starting to change in China, they're starting to do something in terms of their property markets, maybe you're getting closer to the end of the rate tightening cycle in the US, then suddenly you could see some level of interest shift back to what are seen as more cyclical trades as opposed to structural trades. Now, I'm not an expert in this, but I do suspect that there are investors across the world saying, where am I getting the benefit of cheap valuations, which you're certainly not getting in India because of the great structural story, but you can get cheap valuations in other parts of the world where there is a potential cyclical story which could unfold, maybe of a much shorter tenure, but is that an opportunity? So I think there is a little bit of that chatter in the markets, and that's the reality of it.
That's the reality of it, the higher allocations that can go to China. So I guess time will tell how much of that is going to be at the cost of India. Now, Vetri, I was going through, your sectoral exposures, the recent additions, recent selling off of stocks. You are betting very heavily on financials. We've all been talking about how financials will year the end and numero uno position. But what I also see is a large exposure to tech, right? Almost 12%. Will you reduce that, just given the kind of headlines that we're getting, out of big tech in the US? Back home in India, the conversation which is also now happening, whether it's hiring, firing in the startup world, margins as far as the IT companies go with their exposure to US and Europe. Would you trim this down?
Sure. Well, first of all, Nantara, you've done a lot of hard work to drill through that data, but I will put a caveat right up there. At UTI Asset Management, we don't operate with a one-size-fits-all approach. Each of the strategies that we run has its own distinct guardrails, which means you will find strategies which could be overweight in a particular sector, and other strategies in that same sector could be running significantly underweight positions. So it's not a one fund house view. We do what is appropriate to each strategy. Having said that, I'm happy to talk about financials. This has been an area where for, I would say, pretty much a year, we've been saying, this is some of the strongest balance sheets that we've seen in the lending businesses coming through a difficult period, which, has gone on for almost 5 or 7 years. And therefore, we thought there was certainly scope for these lending institutions to sort of gain incremental market share. There's a market consolidation story. There's an interest margin expansion story, and therefore improvement in ROAs. Now, we're glad to see a lot of that has played out. And I must, when I look at the valuations, also admit that valuations are no longer as attractive as they were at the start of the year. But we still think we are sort of mid-cycle as far as the financials sector and particularly the lending businesses is concerned. So that's something that we do favor in many of our strategies. When you talk about IT, I think you'll see a lot more differentiation across strategies. The growth quality strategies have tended to stay overweight IT because that business in terms of quality and growth ticks all the boxes. Our more value-oriented strategies actually had backed away from IT, primarily on valuations going back more than a year. But with I think the sell-off that we've seen in the IT space, there has also started to be some degree of a valuation correction. Earnings for 23 still look like they are coming in reasonably well. So we are starting to gain a lot more valuation comfort today in IT, which we didn't have a year ago. So actually, incrementally in some of our strategies which are underweight IT, the valuation and risk reward has now incrementally, in our opinion, turned slightly more favorable, if not certainly for sure, it's in neutral territory. So, incrementally we are nibbling in IT.
Vetri, I think the big takeaway this morning has been the fact that Brent is now at a 1-month low and there is a cool off in metals as well, right? I mean, you've got copper and aluminum, which are now both quoting at 2 to 4 month lows. The point that I want to ask is whether or not this leaves any sort of headroom for the Fed to not move at the pace that it's chosen to do, or for that matter, central bankers across the world. And I ask this even as of last night, 2 Fed officials indicating that Fed is pretty much on course for more rate hikes. But is it going to be at a slower pace or a slower quantum than earlier anticipated?
I think the markets have already started to discount in the US context a potentially slower trajectory of rate hikes. But I think as the Fed governors made the point yesterday, I think we're still sort of grappling with where that peak rate might be. Will it be, 480, 490, or will it go above 5%, which is what some of the governors were pointing to yesterday. Commodity prices actually have been now in a sell-off, which goes back, well off the highs that you saw in March, immediately after the Russia-Ukraine conflict broke out. But now, if you look back even over a year, commodity prices have given back significant amount of their gains. In fact, I would argue, except for natural gas and crude oil, many of them are actually negative on a one-year basis. But I think the structure of US market inflation has got to do as much with the services side and an extremely tight job market, right? Till sometime back, for every person looking for a job, 2 jobs were available, right? So that's how difficult the job situation was there. Now, that's unique to the US. It's not necessarily the situation which you would find, for argument, in India or many other parts of the world. So I think the factors driving the thought process of the US Fed to continue to hike rates has got to do a lot with labor markets, not necessarily with commodity markets. But to the extent commodity prices cool off, and anyway, the base impact, remember, will start kicking in by the time we get to March, I think we can take some comfort that, the peak rates are now looking reasonably well in sight. Equally, there could be developments, just as the whole Ukraine-Russia conflict came as a surprise to markets and to economists and to central bankers. Who knows, what that particular crisis, how it plays out over the next few months. Because as we know, the script has gone very differently from what anybody expected 6 months ago. So I think there are reasons to believe that the pace of rate hikes will certainly slow in the US. But yeah, we're still grappling with, what that peak rate will be. And mind you, when you look at indicators which are available in the US, anyway, the markets are already aware that there's a 50 to 60% probability of a recession in 23. So I think a lot of the market indicators are anyway pricing in a slowdown.
Vetri, hi there. Good morning. Unless you're living under a rock, you wouldn't have noticed the kind of returns that we've seen within the entire defense space, or even railway stocks that are now making a very unlikely comeback. Within this entire space, do you think that there is merit for investors to look at these sectors as a long-term story, in particular, given the fact that the government has been clearly pushing for infrastructure growth?
Well, point number one, I would say the reason to buy anything should always be valuations and risk reward, right? I mean, just because railway and defense stocks have done well over the last 1 year is not a great reason to look at them. I mean, just go back and look at history, right? A year ago, you could have said the same for IT, and look how terribly IT has done over the last 1 year. A year ago, we loved auto, which had done really poorly. It's done well this year. So I'm not a great fan for just, jumping into something because it's done well. I think it's a question of where does the risk reward actually favor you, and a large part of where risk reward favors you has always got to do with starting valuations being attractive. So honestly, jumping into a moving bandwagon of defense at this point of time, not my cup of tea. Maybe it fits other investors, but not my cup.
All right, not your cup of tea to jump onto the defense bandwagon, but I know what is your cup of tea, and that would be the domestic pharma opportunity. You've said that that space remains very attractive.
And that's purely coming from a contrarian perspective. It's disappointed. We had a little whiff of outperformance in 2020, but now when I look back over the last 3-4 years, the sector has underperformed dramatically. Valuations still looking very attractive on a relative basis. And I think we are starting to see quite a few companies, clean up their act together in terms of getting their ROC structures back in place, trying to focus their expenditure, on their key growth businesses for the future. So in general, that's an area where I think the risk reward is a lot more attractive. There's a lot more pessimism which is visible in the valuations, and that's a reason for me to look at it. I think at this point of time, and very broadly speaking about the market, everything to do with India's structural growth story, I would say, is actually priced quite well. The risk reward is not particularly attractive. So if you've got to go looking for what is particularly attractive in terms of risk reward, I would actually say you've got to look at Europe facing businesses. You've got to look at emerging market facing businesses, look at global cyclicals, look at US related cyclicals. And in the Indian context, one of the areas which I think actually has a great structural story is actually healthcare, but it's not trading in line with that because their near-term numbers have been so muted. So, I'm always tempted to look at what are people ignoring, because that's where the opportunities tend to be. There's no point chasing what's already being talked about, on ET now already as something which is running around.
Okay, so we'll leave that chatter for the next time when you are ready to come on ET Now and share all of that. Thanks so much for being here with us today live on the show.